like to start off by talking about how we can lower income taxes for business owners. That one section of IRS code, section 162, it's overlooked, and it's surprisingly how many business owners don't know anything about it, where you could cut your taxes down, if it's a C Corp primarily, how we could cut the taxes down, executive bonus plan, where you could put money away into some sort of an investment. A lot of people use annuities or life insurance because of the benefits that it brings to the table. People need insurance at the end of the day to protect their family and the business. And that also it brings in the tax deferral and then tax-free loan provision that you don't have to pay the loan interest back. It comes off the death benefit. That accomplishes a lot of things. And also, the new products also give you the long-term care benefit with a handful of companies in the industry that we work with. And that's really the benefit: cutting your taxes down for the business, tax-deferred growth, tax-free withdrawal, which is amazing.
As a business owner, I know it's lonely at the top, and I know it can also be really good to be the king. I saw a license plate on the way over here. It said, "Thank God for the IRS. Without them, I'd be filthy rich." But the thing is, people don't understand that the tax code was actually written specifically to benefit business owners, to provide benefits, mitigation tools, and the like for people who take risks, create products, become responsible for employment, and create dynastic income streams. And there are a number of tools that are available that can really help. What's really important to understand, though, is for all the types of vendors and service providers out there for business, the only service provider whose actual raison d'etre, for lack of a better term, reason for being, is a licensed fiduciary. That raison d'etre is to proactively, based on what you anticipate earning, show you mechanisms to lower your anticipated tax liability, and will actually walk you through how to execute on those steps so that you actually do get to keep that money. You're not at risk for running afoul, and you're not kind of left, as we say in the military, alone and unafraid.
That's the most important thing. So the other subject I want to talk about is the defined benefit plans. That's another area where you could do it's a simple defined benefit plan where you could get a big tax deduction. It's like a big IRA. You could get upward of $170,000, $80,000 on tax deduction, and a section of defined benefit. It's called Section 412I. i.e. that gives you even higher deduction that you can do and be able to deduct on your taxes. And we work with third-party administrators and the right people that they know and specialize in this marketplace to cut your taxes down. I've talked to people that make over $1 million a year and they don't know anything about it. And again, CPAs are great people to do your tax return, but they are not licensed financial planners that they can talk about this stuff and bring these things to life. And our job is to help you coordinate and bring these things to your CPAs and attorneys' attention. The third area, I wanted to talk about the charitable LLCs, where this is for folks that they have large income over $1 million and they like to lower their taxes even more.
And like at the end of the day, let's say you've exhausted all your tax mitigation approaches and you still feel like, what, there's just too much income coming in. I really don't want to have to cut a big fat check to Uncle Sam if I really don't have to. Well, there's a tool, it's called charitable tax planning. Its purpose is to utilize the tax code and the charity of your choice to help increase your deductions so that you can increase your cash flow. And you can use these deductions to offset up to 50% of your net income. And if you have more deductions than can offset that income, you can carry those deductions forward for up to 5 years. For our California people, you're having to pay pretty large state income taxes, right? Historically, you'd been able to write those taxes off of your federally taxable earnings, resulting in a pretty substantial deduction. Well, 2017, the Tax Cuts and Jobs Act lowered the amount that can be deducted from taxable earnings to $10,000. Now, the big beautiful bill passed in 2025 increased that amount from $10,000 to $40,000, which can be advantageous. But that all being said, if you're earning above $1 million, that $40,000 is nice, but it's not going to cut it as far as state income taxes. Whereas if you run those state income taxes through your corporation, whether your corporation is responsible for earning your money or not, that becomes a business expense which renders it fully deductible against your federally taxable earnings. If this is,
cool.
It's absolutely subject to changes to the tax code, and it's always unique to your situation. But that's, again, one of the benefits of working with Haas Financial is we uniquely tailor our solutions to fit your unique situation.
So before we wrap this up, talk about employing your children and your businesses and how can we cut taxes down there. What are the benefits of doing that?
Oh, absolutely. Well, the benefits are myriad. I mean, one of the things that we're trying to address is financial literacy. Is we want to inculcate good financial habits for our children as they grow. And one really great tool is putting your child on payroll and then deducting their salary from your taxable earnings. Then that salary is then taxable to them as opposed to you. Their marginal income tax bracket is going to be substantially lower than yours if it even exists at all. And then you can take that salary, whatever you're paying that child, and put it in something for their future. One such model is a custodial Roth IRA or possibly permanent insurance solutions. Either way, you have options to grow that money tax deferred. You have options to make an investment in your child that child, it becomes incumbent upon them to match by behaving, by growing, by learning, by showing interest in their future.
Yeah, it's brilliant. It's really unique because you're deducting this salary, the plan, depending on where you put it. We could put that through a life contract.
Oh, yeah.
Again, life insurance contract where your money goes tax deferred is like Roth IRA or 529 plans where you could pull the money out for their education later. That life insurance, one of the unique features that it doesn't come on the map for FAFSA purposes if they can get a loan on their own. So that's a feature that I think it's important. And of course, if they don't use it, it sits there and this cash value, I mean, it just mushrooms out to by the time they're age 65, they'll probably, depending on how much you're putting in there, they could literally have $1 million of cash in the policy depending on the size of the contract. So all those things are little things we pay attention to and just tailor fit it to your needs. So if you're interested in these income tax items we talked about, you could click on the link, and this is just barely scratching the surface. There's so many. Everybody's situation is different. And our job is, as a fiduciaries, we're here to help you kind of coordinate this thing based on what your needs are. So click on the link below and we'll be there to help you. Thank you.